Ladies and gentlemen, the Nifty has witnessed one of the worst drawdowns in the post-COVID era over the last 6 months. The Nifty is down more than 15% from its most recent all-time high. The Midcap index is down more than 20% from its most recent all-time high, and the Smallcap index is down more than 25% from its most recent all-time high. But what if I told you that despite such a severe downturn, our very own AlphaSIP strategy, which is our flagship offering for our paying clients, has managed to deliver not just positive returns, but positive returns to the tune of 9.4% per annum, even as a carnage has unfolded across Indian equity markets over the last 6 months? How is that even possible, you would ask? Well, that's exactly what we are going to explore in this video. Ladies and gentlemen, hi. Welcome to this video where I intend to discuss how the AlphaSIP strategy, which is our flagship offering for our paying clients, has performed over the recent weeks and months, and how it has been instrumental in offering an incredibly high level of downside protection to our clients during the course of the downturn in Nifty that we have witnessed since September of 2024. But before that, I want to address the concerns and criticism of a section of my viewers who now strongly believe that I have now lost all credibility because I got this call of mine with regards to a possible melt-up in the Nifty after the start of rate cuts by the Fed completely wrong. Not just that, according to some amongst this section of viewers, I committed the additional sin of not providing adequate guidance to my viewers once this melt-up thesis of mine started to go wrong. Ladies and gentlemen, harsh criticism, trolling, these are things that I've learned to take in a stride. This is part of the game for any content creator these days. But the sheer volume and ferocity of adverse comments that I received in response to my last video that I had published on 2nd of March 2025 was such that this is something that I thought deserved a response. And that's why, ladies and gentlemen, before I talk about anything else in this video, I want to first revisit this market call of mine with regards to a possible melt-up in the Nifty after the start of rate cuts by the Fed. And I want to talk about how my position with regards to this melt-up call has evolved over the last couple of months, and where is it that I stand right now with regards to this melt-up call. Now, first thing first, there's no escaping the fact that I've had this long-held view that we are likely to get this one last melt-up in equity markets once the Fed starts to cut Fed funds rate. But my dear friends, when I say that we are likely to get a melt-up in equity markets, that doesn't mean that we cannot get air pockets on the way for equity markets. We cannot get interim drawdowns on the way for equity markets. We absolutely will. That's the nature of equity markets. When it comes to equity markets, nothing goes up or down in a straight line. And the pullback that we are witnessing in equity markets in September of 2024, I believe is but an example of one such air pocket, one such interim drawdown in equity markets. That it will come to an end sooner rather than later. And that's why, ladies and gentlemen, I continue to remain steadfast in my call that we will get this one last melt-up in equity markets before the current business cycle comes to an end in a not too distant future. And it's not blind belief. There are hard reasons to believe that the conditions necessary for a melt-up to materialize are finally starting to fall in place one after another. And this is something that I explained in details in this most recent video of mine that I had published on 2nd of March 2025. If you haven't seen this video, I'll strongly encourage you to have a look at this video. You can find a link to this video in the description. But ladies and gentlemen, this is not something that is dawning upon me today. The fact that things are likely to play out a little differently in this business cycle compared to previous business cycles, and that we are not really likely to get this one last melt-up in equity markets immediately in the aftermath of the Fed starting to cut Fed funds rate is something that I very clearly sensed very soon after the Fed started to cut Fed funds rate in September of 2024. And that's because in the current business cycle, as soon as the Fed started to cut Fed funds rate from September of 2024 onwards, we could witness a very big spike in US government 10-year bond yields. And this spike in US government 10-year bond yields in turn led to a big spike in what is called the MOVE index, which essentially tracks the volatility in the US government bond market. Now, a spike in bond market volatility has historically never really worked out very well for equity markets. That's why as soon as we got this big spike in the MOVE index, it became very, very clear to us that we are not really going to get a melt-up in equity markets, at least at this stage. And that the spike in bond market volatility is going to lead to a drawdown in equity markets instead. And that's why, ladies and gentlemen, as soon as we got this big spike in the MOVE index in the second half of October of 2024, we immediately initiated interventions across our client portfolios and moved towards reducing the equity exposure across all our client portfolios. Not just that, after having initiated the necessary interventions across our client portfolios, I also made it a point to update you, my dear audience, in the video that followed immediately thereafter, that I was no longer bullish about equity markets. Ladies and gentlemen, this is the first video that I had published after my bullish view towards the equity markets had changed because of the spike in the MOVE index. I had published this video on 9th of November 2024. And my dear friends, in this video, I have unambiguously stated that I am no longer bullish about equity markets and that I've cut the level of equity exposure across our client portfolios. And you don't have to take my word on the face value. All you got to do is to listen in as I play this short 1-minute clip from this video. And this brings us to a very important question, which is that what should be our approach towards equity markets at this stage? If the base case view is that there is very little chance of inflation being able to stage a comeback at this stage, if the base case view is that the high bond yields that we have witnessed over the last couple of weeks will very likely start to come down sooner rather than later, then should we use the current bout of volatility in equity markets to make fresh investments into stocks? And my unequivocal answer to that is no, not yet. And the reason for that is that both these two variables that we studied earlier in this video, US government bond yields as well as US bond market volatility, both these two variables continue to remain very, very elevated. As we earlier saw, on the day before the election day in US government 10-year bond yields had shot up to as high as 4.31% and the MOVE index had shot up to as high as 136. And as long as these two variables continue to remain this elevated, the risk of a further correction in equity markets will continue to persist. And that's the reason at this stage, we have also reduced equity allocation in the portfolio of our clients. So there you heard it. We have also reduced equity allocation in the portfolio of our clients. This is something that I'm not saying today. This is something that I have been saying all the way since 9th of November 2024. And you can go and check almost every single video of mine since 9th of November. And I have reiterated this point again and again in all my videos since 9th of November. Now coming to the most important part of this video, which is the specifics of the interventions that we rolled out across our client portfolios as this ongoing correction played out over the last 6 months. My dear friends, as I have reiterated many times in my previous videos, before being a content creator, before being a market watcher, before being an analyst, or any such fancy title that is attached to me, before any of these, my primary function is to manage wealth for my clients. And this is what I am before being anything else. And that's why, ladies and gentlemen, I do not have the luxury to just theorize about what's going to happen to equity markets. I do not have the luxury to just write research reports about what's going to happen in equity markets. Instead, I have to take hard calls in black and white with respect to how to position my client portfolios as market upheavals play out. And my dear friends, in this video, I want to showcase how is it that we positioned our client portfolios as the ongoing correction in the NIFTY unfolded over the last 6 months, and what is the impact that has had on the final return of the investments of our clients who have invested as per our AlphaSIP strategy. Now, in order to demonstrate how we have been positioning our client portfolios over the last couple of months, while I cannot take the liberty to expose our client portfolios on a public forum, I can take the liberty to do so with respect to my own personal investment portfolios, where I have been applying the AlphaSIP logic. The first portfolio is one in which I have been applying the AlphaSIP logic to a large cap equity fund. Now, for those of you who are not familiar with what AlphaSIP is, well, AlphaSIP is our flagship offering for our paying clients. And I have created a dedicated video explaining the underlying logic of the AlphaSIP strategy. And in this video, I have also explained how's the historical performance of this strategy been like. You can find a link to this video in the description. Now, those of you who are familiar with the AlphaSIP strategy would know that in the AlphaSIP strategy, we periodically rebalance the investment portfolio between equity funds and debt funds. During times when liquidity conditions are easy, we switch most of the funds in the investment portfolio into equity funds. And during times when liquidity conditions start to become very, very tight, these are of course times when equity markets typically do not do very well. During such times, we typically switch most of the funds in the investment portfolio into debt funds. And to execute the AlphaSIP strategy, we usually make use of ULIP schemes of various leading life insurance companies. And that is because when you do switching between funds, the switching becomes a lot more cost efficient as well as tax efficient when you do switching between ULIP schemes. Because when you switch between ULIP schemes, there is no exit load that is applicable. And most importantly, when you switch between ULIP schemes, there is no incidence of short-term or long-term capital gains tax. Mind you, this is a unique benefit that is available only in case of ULIPs. This benefit is not available when you switch between funds using any other instrument, such as mutual funds, AIFs, PMS, or even direct stocks for that matter. And that's why the periodic switching that we do between equity funds and debt funds as per the AlphaSIP logic becomes a lot more efficient when done using ULIP schemes. ULIPs, of course, have their fair share of problems too. In particular, they suffer from very bad reputation because of egregiously high charges, because of which investors who have historically invested in ULIPs have more often than not ended up with very poor returns. And this is something that we have specifically sought to address while choosing the right ULIP for executing the AlphaSIP strategy. For executing the AlphaSIP strategy, we make use of a brand new breed of very low cost ULIPs called zero allocation charge ULIPs. If you want to know more about these zero allocation charge ULIPs and how they help address the shortcomings and drawbacks of traditional super high cost ULIPs, then this is again something that I have covered in this video, in which I have provided an overview of the underlying logic of the AlphaSIP strategy. I would once again urge you to go and have a look at this video. You can find a link to this video in the description. Coming back to the personal investment portfolios, I want to showcase in this video. As you can see, the ULIP schemes I have made use of here are of this company called Bajaj Allianz Life Insurance Company. And the portfolio you see here is first of the three personal investment portfolios I want to showcase in this video. In this investment portfolio, the equity fund that I'm using as part of the AlphaSIP logic is Bajaj Blue Chip Equity Fund. And the funds that I'm using on the debt side are Bajaj Bond Fund and Bajaj Liquid Fund. So in this investment portfolio, the equity fund that I've been using is a large cap fund. My second investment portfolio where I have been applying the AlphaSIP logic is this one. In this portfolio, as you can see, the equity fund that I've been using is Bajaj Accelerator Midcap Fund 2, which is essentially a midcap fund. And the funds that I've been using on the debt side remain the same, Bajaj Bond Fund and Bajaj Liquid Fund. And finally, the third investment portfolio where I've been applying the AlphaSIP logic is this one. In this portfolio, as you can see, the fund that I'm using on the equity side is Bajaj Small Cap Fund. And the funds that I'm using on the debt side remain the same, Bajaj Bond Fund and Bajaj Liquid Fund. So these are the three investment portfolios that I have. And I've been applying the same AlphaSIP logic to all these three investment portfolios. The only difference between the three is with respect to the choice of equity fund in the three investment portfolios. In the first one, I have used a large cap equity fund. In the second one, I have used a mid cap equity fund. And in the third one, I've used a small cap equity fund on the equity side. And the funds that I've been using on the debt side remain the same across the three portfolios. It's a combination of Bajaj Bond Fund and Bajaj Liquid Fund. In case of all these three investment portfolios, the investment amounts remain the same and the investment dates also remain the same. I started investing in these three investment portfolios on the same date, which is December 2023. To be precise, 27 December 2023. And since December 2023, I've been doing a yearly SIP in each of these three investment portfolios of 2.4 lakh rupees per year. So I made the first yearly investment of 2.4 lakh rupees in each of these three investment portfolios on 27th of December 2023. And then I did the second yearly investment of 2.4 lakh rupees in each of these three investment portfolios on 3rd Jan 2025. So far, I have made a total investment of 2.4 plus 2.4. That's equal to 4.8 lakh rupees in each of these three investment portfolios. Now, let me talk about the most important thing I want to discuss in this video, which is how did we position our client portfolios as this ongoing correction started to play out over the last 6 months. Basically, we rebalanced our client portfolios twice since August of 2024. The first rebalancing happened on 9th of August 2024. On this date, we in fact pushed up the equity allocation in our client portfolios to 75% equity. And that is because in early August 2024, we got a correction of more than 4% in the NIFTY because of the Japanese central bank hiking interest rates in Japan, and that in turn leading to sell-off in equity markets around the world because of fears of unwinding of what is called the yen carry trade. We of course used this pullback in equity markets in early August to up the equity allocation across our client portfolios all the way up to 75%. And that is because our models were clearly indicating that the pullback in equity markets because of fears of unwinding of the yen carry trade is unlikely to last for a very long time. The next time we rebalanced our client portfolios in 2024 was on 5th of November 2024. On this date, we reduced the equity allocation across our client portfolios from 75% all the way down to just 25%. By now, of course, the ongoing correction in the equity markets had already started to unfold. But the specific trigger for us to reduce equity allocation across our portfolios in November of 2024 was this big spike in the MOVE index. On 4th of November, the MOVE index went to a high of 136. And this in turn was the cue for us to cut equity allocation across our client portfolios to 25% the very next day, that is on 5th of November 2024. Now, with respect to these dates on which I say we rebalanced our client portfolios through 2024, you don't have to take my word on the face value. All this is documented and can be verified from the statements which I have made publicly available. The statements of all three of my AlphaSIP ULIP portfolios can be downloaded through the links that I have provided in the description of this video. Let's do a quick check of these dates anyways by going through the statement of one of these three investment portfolios. So let me run you through the statement of this third AlphaSIP investment portfolios where I have been rebalancing between the Bajaj small cap fund on the equity side and the Bajaj bond fund and Bajaj liquid fund on the debt side. So here's the statement. As you can see, the statement has been issued by Bajaj Allianz and the statement is in my name. That's Indraanil Guha. The only detail that I have masked in this statement is the policy number. Because through a combination of policy number and a few other personal details of mine that are publicly available, one can actually log into my Bajaj Allianz account and they can start initiating switches between funds in my investment portfolio. And to avoid that, I have masked the policy number. Now, if you scroll down to the bottom of this statement, you'll see that I started investing in this portfolio on 27 December 2023 and so far I have done 2 yearly SIP investments in this investment portfolio. I invested 2.4 lakhs in this investment portfolio on 27 December 2023 and then again on 3rd of January 2025, I did the second investment of 2.4 lakh rupees in this investment portfolio. Now let's verify the dates on which I said we rebalanced our client portfolios through 2024. Now, the first time we rebalanced our client portfolios in 2024, as I mentioned, was on 9th of August 2024. On this date, we pushed up the equity allocation across our client portfolios all the way up to 75%. Now, let's see if we can find evidence of this rebalancing in the statement. In the statement, we can see that there was a switch out transaction of 1,35,621 rupees from Bajaj Liquid Fund on 9th of August 2024. And then if you scroll down, you can see that on the same date, there was a switch into the Bajaj Small Cap Fund on 9th of August 2024 of exactly the same amount, 1,35,621 rupees and 2 paisa. This is basically the switch transaction through which we pushed up the equity allocation in our client portfolios on 9th of August 2024 all the way up to 75%. The next time we rebalanced our client portfolios, as I just mentioned, was on 5th of November 2024. On this date, as I just mentioned, we pushed down the equity allocation across our client portfolios from 75% all the way down to just 25%. Now let's see if we can find evidence of this rebalancing in the statement. Well, when we look at the statement, we can indeed see that there was a switch out of 1,35,591 rupees 61 paisa on 5th of November 2024 from the Bajaj Small Cap Fund. And then on the same date, that is 5th of November 2024, there was a switch into Bajaj Bond Fund of exactly the same amount, that is 1,35,591 rupees 61 paisa. So this is basically the switch transaction through which we basically push down the equity allocation across our client portfolios on 5th of November 2024 from 75% all the way down to 25%. Ladies and gentlemen, at this stage, I wish to highlight that this is yet another unique feature of ULIP. As you can see in this case, the switch in and switch out, both these transactions happened exactly on the same date, that is 5th of November 2024. This is quite unlike what you see in case of, let's say, mutual funds. In case of mutual funds, when you initiate a switch transaction, it's only the switch out transaction that gets executed on the date on which you initiate the transaction. And the switch into the target fund typically takes anywhere between 1 to 2 working days to be completed. And the implication of this is that if you suddenly get a sharp correction in equity markets on any given business day, and you want to take the benefit of this correction to switch your funds from debt funds to equity funds, then this switch is done best when done through ULIPs. Because in case of ULIPs, as we just saw, the switch in and switch out are both completed on the very same date. Whereas in case of mutual funds, the switch transaction can take anywhere between 1 to 2 working days to be completed. And if by chance markets recover by that time, then you would have effectively missed the opportunity to move funds from debt to equity at a lower NAV. So that's a very important benefit that you get when you do switching between funds using ULIPs. The other important benefit that you get is, as you can see in the statement itself, the switch in and switch out amounts are exactly the same. As you can see, the amount that got switched into Bajaj Bond Fund on 5th of November 2024 was 1,35,591 rupees and 61 paise. And the amount that got switched out of Bajaj Small Cap Fund on that date was exactly the same amount, 1,35,591 rupees and 61 paise. There's no deduction that has been done by the ULIP company during the course of this switch transaction. There's been no exit load that has been applied by the ULIP company. There's been no STT that has been applied by the ULIP company. There's been no TDS that has been applied by the ULIP company. Whatever got switched out to the last paisa got switched back into the target fund. Once again, this is a very big difference compared to mutual funds, where you get a host of deductions which are applied by the asset management companies whenever you do switching between funds. Now let's see what's been the final result, the final outcome of all these rebalancing transactions that were carried out in this portfolio right through 2024 in terms of the return that this portfolio is clocking currently. As I showed you in the statement, I've so far done 2 yearly SIP investments in this portfolio of 2.4 lakh rupees each. Against these investments, let's now try to find out what's the current value of funds in this investment portfolio. And for that, we need to go back to the statement. So here's the statement of the investment portfolio once again. And as per this statement, if you scroll down, you can see that the value of the funds in this investment portfolio right now is 5,04,898 rupees and 91 paise. Now this statement is of 3rd of March 2025, which basically means that the value of the funds in the investment portfolio that I just mentioned was as of the previous business day, which was 28th of February 2025. This means that against an investment of 2.4 lakhs on 27 December 2023 and another investment of 2.4 lakhs on 3rd January 2025, the current value of the portfolio as of 28th February 2025 is 5,04,899 rupees. This translates to an IRR of 7.9% per annum since 27 December 2023. Similarly, if you try to find out the return of the other 2 investment portfolios, you will find that in case of the mid-cap portfolio, exactly the same amounts were invested on exactly the same dates. That is, 2.4 lakh rupees was invested on 27 December 2023, and once again 2.4 lakh rupees was invested on 3rd January 2025. And the current value of this investment portfolio is 4,99,908 rupees, and you can verify this amount by going to the statement of this investment portfolio, which I have made publicly available. The link to the statement can be found in the description of this video. So based on this translates to an IRR of positive 6.3% per annum since 27 December 2023. And finally, in case of the large cap portfolio, once again, the same amounts were invested on the same date, and the value of this portfolio currently is 4,90,454 rupees. Again, you can verify this amount from the statement of this portfolio, and this translates to an IRR of positive 3.3% per annum. Now let's put all these numbers in the same graph, and when you do that, you get to see what has been the performance of the AlphaSIP strategy since December 2023. These are basically the annualized returns that you would have got had you done a SIP since December 2023 as per the AlphaSIP logic using Bajaj Allianz's large cap fund, mid cap fund and the small cap fund. And if you think that these return numbers are not impressive enough because these are after all single digit returns, then I want you to have a look at what is the kind of return that you would have clocked had you done a regular SIP in these very same funds since December 2023. As you can see, the return figures are deeply negative in the case of all the 3 funds. And if you want to look at the performance of a regular SIP at an index level, then here you go. These are the annualized returns that you would have got had you done a regular SIP since December 2023 in the Nifty 50 index, in the Nifty Midcap 150 index, and in the Nifty Smallcap 250 index. As you can see, the overall picture doesn't change much even at an index level. Return of a regular SIP continues to remain negative in all the three cases. In fact, return figures are deeply negative in case of the mid-cap index and the small-cap index. And why is that the case? That's the case because all these three indices have suffered very severe drawdowns since September of 2024. As you can see, the Nifty has been down about 15.5% from its most recent all-time high witnessed in September of 2024. The Nifty Mid-Cap Index has been down about 21%, and the small-cap index has been down an eye-watering 26% from its most recent all-time high. And because of these severe drawdowns in case of these three indices since September of 2024, you get to see these deeply negative numbers in case of the performance of a regular SIP in these three indices since December 2023. And how is it that the performance of the AlphaSIP strategy has been in such stark contrast compared to the performance of a regular SIP? Because in case of the AlphaSIP strategy, as you can see, the annualized return figures are positive in all the three cases. More importantly, the overall trend of the annualized return figures are completely divergent between AlphaSIP and regular SIP. In case of the AlphaSIP strategy, the annualized return figures improve as you move from the large cap fund to the mid cap fund to the small cap fund. Whereas in case of a regular SIP, the annualized return figures progressively get worse as you move from large cap to mid caps to small caps. And the reason for that is the magic that we bring to table when we do this monthly rebalancing of your investment portfolio as per the AlphaSIP logic. Because of this monthly rebalancing of your portfolio, you get to stay almost fully invested in equity markets during times when equity markets are rallying, and thereby you get to capture the upside offered by equity markets during times when markets are witnessing strong rallies. And yet at the same time, this strategy also ensures that you are out of the market to a large extent as soon as liquidity conditions start to tighten, and as a result, markets start to correct. And that's why the return figures are so impressive when the AlphaSIP strategy is applied to a small cap fund or a mid cap fund. These were the categories that were rallying the most when liquidity conditions were easy and markets were still rallying. And the AlphaSIP strategy essentially helped capture this upside during times when the markets were still rallying. But as soon as liquidity conditions started to tighten and markets started to turn, the AlphaSIP strategy ensured that the equity allocation of the investment portfolios were curtailed down to as low as 25%. And that's why even though the mid-cap and small-cap indices corrected by more than 20% from their all-time highs, the corresponding AlphaSIP portfolios hardly face the brunt of this downturn. So with the AlphaSIP strategy, you effectively get to keep the upside that was generated during times when the markets were still rallying, and yet you are largely protected from the downturn once the market starts to correct. That's like getting to keep the best of both worlds, isn't it? And finally, ladies and gentlemen, impressive as the return figures of the AlphaSIP strategy are, even this doesn't capture the full upside created by the AlphaSIP strategy. What do I mean by that? Well, in case of ULIP investments, as I have explained in some of my previous videos, the investor also gets a certain amount of insurance cover. And the premium for that insurance cover is actually deducted from the investment corpus itself. And the return figures of the AlphaSIP strategy that you see out here on the chart have been calculated based on the value of the funds in the AlphaSIP portfolio after taking into account the deductions that were done from the investment corpus to pay for the insurance component of the ULIP plan. So if it were a pure investment plan and there was no insurance to pay for, then the value of the funds in the AlphaSIP portfolios would have been higher still. And consequently, the return figures that you see out here for the AlphaSIP strategy also would have been higher still. And for a like-to-like comparison, we at least should be aware of what those AlphaSIP return figures would have been had there not been any insurance component to pay for. So here you go. This would have been the return of the AlphaSIP strategy with the large cap fund, mid cap fund and small cap fund had there not been any deductions to pay for the insurance component of the ULIP plan. Ladies and gentlemen, this is what makes for a truly like-to-like comparison between the performance of the AlphaSIP strategy and a regular SIP since December 2023. And boy, what a difference we have got. A regular SIP in the small cap index since December 2023 has produced a return of negative 15.9% per annum so far. Compared to that, the AlphaSIP strategy when applied to the Bajaj small cap fund during the same time has produced a return of positive 9.4% per annum. Ladies and gentlemen, you can't ask for a difference in performance that is starker than this. Ladies and gentlemen, that's pretty much the roundup I wanted to provide on the performance of the AlphaSIP strategy. during the course of the correction that we have witnessed in equity markets since September of 2024. If you are interested in signing up for the AlphaSIP strategy, then you can do so now. As I announced in my last video, we have reopened the window for onboarding new clients until 31st of March 2025. And during this time, as I announced in my last video, we'll be accepting a maximum of 100 new clients. If you're interested in signing up for the AlphaSIP strategy, then please go to our website, metacaps.ai/products, which is where you will find all the details about the AlphaSIP strategy. We offer the AlphaSIP strategy in 3 variants, and if you are interested in any of the 3 variants, then please register through our website for the variant that you are interested in. And if you are a retail investor, you must check out the AlphaSIP Tax Saver variant because this is the one which is most popular amongst retail investors. And the reason for that is that in case of this variant, the entire maturity proceeds are tax-free as per current tax laws, as long as your investment amount is within 2.5 lakh rupees per year. Once we receive your registration, somebody from our sales team will reach out to you to advise you on the next steps. Thank you very much for watching this video. Goodbye till we meet again in the next video. Ladies and gentlemen, that's it for now. This brings me to the end of this video. I sincerely hope that you liked the insights that I shared during the course of this video. If you did, then please do like and share this video, and please do consider subscribing to my channel.